Hi, my name's Eric, and I'll be reading you selections from this week's Barrons magazine dated December 8th of 2025. This reading is produced by the Audible Local Ledger, a reading service exclusively for people who are blind or print disabled. And we'll start with Up and Down Wall Street by Randall W. Forsyth. The title, "'Tis the Season for Predictions, Why It Pays to Be Skeptical." Predictions are hard, especially about the future. So said the leading philosopher of the past century, Yogi Berra, although originally it was attributed to Niels Bohr, the quantum physicist, which isn't surprising, since uncertainty is a core concept of quantum mechanics as described by Werner Heisenberg. Regardless of who said it first, the contrast between their modesty about predictions and the hubris of market forecasters who confidently look to what they call the foreseeable future is striking. I've recently read with skepticism scores of economic forecasts conjured up at this time of year. An exception among them is the purposely titled Outrageous Predictions proffered annually by Saxo Bank of Denmark. This year's most provocative prediction was that the impending nuptials of Taylor Swift and Travis Kelce would provide a shot of stimulus to the world economy. So, after Kelce's Kansas City Chiefs are probably, quote-unquote, eliminated from the National Football League playoffs, the bank's John J. Hardy hypothesizes that the tight end and the pop superstar will quickly wed and that she will immediately become pregnant. The result? Hundreds of millions of Swifties will then quickly emulate their idol, setting off a marriage and baby boom among millennials and Gen Zers. World economic growth forecasts will be revised up by 1 percentage point annually for the next 5 years, says Saxo, leading Wall Street to dub the episode the Swiftie Put. Leaving aside how easily a 30-something woman can conceive, a fact that's helped a thriving in vitro fertilization industry, other couples confront arguably a bigger hurdle to starting a family: affordability. In fact, that would be our nomination for the word of the year, rather than the phrase rage bait, so dubbed by the Oxford Dictionary. President Donald Trump asserts that Americans' complaints about affordability are a con job and a hoax perpetrated by Democrats. But Jim Bianco, eponym of Bianco Research, points to a Politico poll that finds 37% of Trump voters agreeing that the cost of living is the worst they've ever seen. That contrasts with economists' assessment of inflation of 2.8% over the past year, based on the central bank's favored measure, or future inflation expectations, which Federal Reserve Chair Jerome Powell asserts are contained, based on implied future price rises embedded in Treasury inflation-protected securities, or TIPS. Regular folks, however, have seen prices rise far faster than their wages in the 5 years since the start of the COVID pandemic, Bianco points out. Consumer prices are up over 26% over that span, while pay has grown just 22%. That's what's reflected in the Politico poll, which not surprisingly was even more negative among Democratic voters. Those sentiments are further reflected in the recent off-year election results, which saw Democrats making gains and Republican eking out a narrow victory this past week in a deep red Tennessee congressional race. As for 2026, who wins the affordability issue wins the midterms, declares the Bank of America strategy team that's led by Michael Hartnett, which regularly delivers astringently non-consensus views. If the administration wants to run the economy and the stock market hot, investors should expect still deeper government intervention, quote, to directly control prices and boost supply in energy, healthcare, housing, insurance, and utilities, they wrote in a November 13th client note. That should produce good news in reduced U.S. electoral affordability anger from an end of the trade war and lower tariffs, they continued. How to control prices in such sensitive sectors and at the same time run a hot economy with loose monetary policy and a wide fiscal deficit while inflation runs above target. Precedents no longer seem to matter these days, but let us turn the clocks back more than a half century. On the Sunday evening of August 15, 1971, President Richard Nixon announced a wage and price freeze, an import surcharge, and the end of the dollar's last link to convertibility into gold at $35 an ounce. With his re-election campaign looming in 1972, Nixon remembered well his loss to John F. Kennedy during the mild recession of April 1960 to February of 1961. Price controls would, in theory, cap inflation, then running over 4%. Meanwhile, terminating the greenback's tie to gold would let the Fed, under the compliant Arthur Barrons, run a stimulative policy to deal with unemployment that's close to 6%. At the same time, protectionist tariffs were imposed. Inflation surged to 8.7% by the end of 1973, with prices rising double digits in the Great Inflation following the Organization of the Petroleum Exporting Countries ratcheting up of oil prices. What are the chances of a replay? Inflation is running well ahead of the Fed's 2% target, while the labor market shows signs of weakening, even though the headline jobless rate remains contained at 4.4%. But as Powell has pointed out, that leaves the central bank no risk-free decision. Could the administration try to unravel this Gordian knot by suppressing prices and pushing for easy money? It's already demonstrated a willingness to intervene in the private sector with massive ownership stakes in corporations such as Intel and others, while demanding payments from NVIDIA and Advanced Micro Devices of 15% of revenues on some artificial intelligence chip sales to China, among other measures. And any number of corporate policies have been altered to be in accord with administration priorities. So it may not rate as much of a surprise if, as Hartnett et al. Put it, there is further transition from an invisible hand of the market to the visible fist of government controls. They see that leading to negative profit margins in these whip inflation sectors. Harking back to another sorry 1970s episode, the Whip Inflation Now, or WIN, buttons handed out by the hapless Ford administration. All of these policy twists and turns would then lower the Consumer Price Index, which the B of A team sees as spurring a contrarian rally in long-dated Treasury securities, with their higher prices translating into lower long-term borrowing costs. Perhaps that could mollify the electorate. But would the bond market go along? The betting markets see Kevin Hassett, director of Trump's National Economic Council, as the odds-on favorite to succeed Powell as Fed chair, based on perceptions that he's most likely to deliver the short-term interest rate cuts that Trump has been very loudly demanding. But a reduction so far of 150 basis points, that's 1.5 percentage points, in the federal funds targets since September of 2024 is translated into a rise of some 50 basis points in the 10-year Treasury yield, the benchmark for key borrowing costs, notably mortgage rates. That's the only time in the past 4+ decades that's happened, Bianco observed. The 4 other Fed easing episodes saw the 10-year yield decline. Peter Tchir, head of macro strategy at Academy Securities, sees a Hassett Fed working more closely with Treasury and the administration, helping to pave the way for lower yields and easier monetary conditions. The Treasury has been working toward that end since 2023 under the Biden administration by leaning heavily on issuance of short-term T-bills while capping the supply of longer-dated securities, writes Mehmet Besern at Rosenberg Research. That effectively has compressed 10-year yields by 20 to 25 basis points, he estimates. This activist Treasury issuance has had the impact of Fed quantitative easing, the central bank's purchase of securities, with 2 important effects. First, it lowers the term premium, the extra return to compensate investors for future uncertainty, on longer maturities below what the budget deficit would imply. Further, he adds, it's been quietly supporting risk assets, notably stocks and corporate credit. Trump's disruptions of the interplay between the Fed, Treasury financing, the banking system, and foreign capital flows will determine the 2026 economy, just as his trade disruptions were drivers of the 2025 economy, predicts Stephen Blitz, chief U.S. economist at T.S. Lombard. Here are the problems he sees. Treasury borrowing will increase 7%, while the U.S. economy will grow 5% in nominal terms, real plus inflation. At the same time, banks would be expected to boost lending to support the economy, which would mean cutting their holdings of government securities. Meanwhile, interest payments represent 14% of federal outlays, more than the military, and they're the fastest growing part of the budget. Further complicating Treasury's problem will be the need for foreign funds, which Blitz sees being deterred by a heightened inflation risk and the massive fiscal deficit. Rising bond yields abroad also reduce the incentive to send capital stateside. In particular, soaring Japan government bond yields have made the domestic market more attractive than U.S. bonds for Japanese investors, after taking into account the risk of a falling dollar. On that score, another of Saxo Bank's outrageous predictions is that the greenback's dominance may be challenged by the Chinese yuan, which Beijing would back with its growing gold reserves, writes Charu Chanana, the bank's chief investment strategist. That would provide something not seen in decades, a currency tied to a tangible reserve, rather than to government promises. Official Chinese gold reserves are at 2,300 metric tons, but unofficial estimates put them at twice that or more, compared with U.S. holdings, according to the World Gold Council, of 8,133 metric tons. As confidence in a golden yuan grows, Shanana sees investors and reserve holders cutting their holdings of U.S. treasuries, raising yields. Meanwhile, the dollar's share of global reserves could fall by a third as the gold-backed Chinese currency becomes a durable second global anchor, ending the dollar's effective monopoly. In the process, she sees gold rising above $6,000 an ounce, nearly a 50% increase. Happy New Year. Moving on to the Streetwise column, written by Jack Huff, in a K economy, a fat cannibal stare down could be bad news. The economy has shifted from a lowercase k to an uppercase one, a Wall Street researcher told me this past week. I nodded and hoped it wasn't a Kevorkian reference. Turns out it's all in the arms. The K's rising one and falling one signify different groups moving in opposite directions. The rich are thriving, while the rest are struggling. With a capital K, the rising arm is more prominent, just as swelling asset prices make this an even better time than usual to be rich. And the lower arm doesn't so much represent the poor, who tend to stay poor, but at least receive inflation adjustments on government assistance, says Mike Reed, senior U.S. economist at RBC Capital Markets. It's really the middle-income folks, say the 20th to 80th percentile. Those are the folks who are being pinched the most. Reed sees implications for investors and policymakers. If top earners are driving spending growth, for example, the economy might be more exposed than usual to stock market volatility. Meanwhile, I see a worrisome trend for letter-based financial metaphors. Already we have S-shaped growth curves, L-shaped recessions, V and U-shaped recoveries, and W-shaped whatevers. If interpreting the economy now hinges on fine differences between uppercases and lowercases, sloppy penmanship could lead to financial ruin. It's time to look beyond the alphabet for something more descriptive. Let's look at an example. Reed points out that from 1970 to 2010, there was just under one retiree for each new worker, whereas now the ratio is ballooned to about 2.5 to 1. You don't need this strong job growth to support a stable unemployment rate, he says. But if stocks tank, boomers eyeing lower portfolio values could hold on to their jobs for longer, exacerbating any uptick in unemployment. This feels important enough to warrant a metaphor, yet too complicated to be summed up by any single letter, even a cursive capital G, if those still exist. What we need is a name that evokes young people waiting for old people to turn over their spots. I'm torn between pickleball hours at the town basketball court effect and restroom at a Rolling Stones concert dilemma. Other strategists have spotted important market wrinkles. At B of A Securities, Jill Carey Hall, who oversees U.S. small and mid-cap research, points out that earnings growth underlying the S&P Small Cap 600 Index is expected to jump from 6% this year to 17% next year. Small companies would go from being growth laggards to leaders. Historically, when that's happened, small caps have outperformed large caps 75% of the time, by an average of 9 percentage points a year. This is both too tempting to ignore and too long awaited to trust. Over the past 15 years, the large cap S&P 500 index has returned 640%, trouncing its small cap sibling by more than 280 points. That's left small caps 30% cheaper than large caps relative to this year's projected earnings. The ideal metaphor here will call to mind something small that's poised to go fast, but isn't nearly assured of success. If you ask me, 2026 is displaying a chihuahua on an e-bike setup. Tiny dogs appear ready to zoom, but their little paws can't reach the handlebars, so really, anything could happen. Among large-cap stocks, has anyone else noticed a developing fat cannibal stare-down? That's where market behemoths, who've been feasting on small competitors for decades, begin to hungrily eye one another's total addressable markets. Alphabet, number 3 by market value, has developed its own zippy artificial intelligence chips with help from number 6 Broadcom, and it's now seen as a threat to number 1 NVIDIA, which says its chips are set apart by its software, along the domain of Microsoft, which is busy battling for cloud AI work with Amazon.com, which is now selling AI chips of its own. Tesla, which has fallen out of the top 7, now says it's all about robo-taxis, but Alphabet's Waymo is the early leader there. Alphabet's YouTube is giving streamers like Netflix and Amazon pause, but Amazon's rapid rise in advertising is a menace to Alphabet and Meta platforms. A fat cannibal stare-down is always a volatile situation, especially when combined with a muffin-top market. Technology, media, and telecom now combine for 45% of the S&P 500. If we're lucky, all of that emerging AI wizardry will help more than it hurts. Deutsche Bank says that artificial intelligence next year will either weaken a fragile job market or boost productivity by more than half a point. It's a classic family reunion bear hug from a cousin you like but who talks too much about crypto conundrum. And I have mixed feelings. Would it be awkward here to change topics to obesity meds and erectile function? Definitely. I wish you had said something sooner. It's just that Oppenheimer and company has been highlighting the role that obesity meds, along with new treatments for cancer, infectious diseases, movement disorders, and more, can play in extending longevity and quality of life. Next up might be more attention to erectile function, which Oppenheimer calls a harbinger of health. Women outlive men by an average of 5.8 years, and that's rising in the U.S., and heart disease, diabetes, and emotional distress are leading reasons. Erectile dysfunction is often the first detectable symptom of these, and it appears to be both a cause and an effect. Treat ED, in other words, and you might extend lives. That makes it surprising that leading ED treatments called PDE5 inhibitors, better known as Viagra and Cialis, are about a quarter century old. Oppenheimer points to a tiny Swedish company called Dyko Pharma and its experimental treatment LIB-01. It's been shown in preliminary trials to work for weeks, not just hours, in a when-needed way rather than an intrusive one, as I understand it. But I don't have the medical grasp of a trained men's downstairs-ologist. Dyko will need more capital and lengthy trials, and it might succeed or flop. But it's nice to see new movement in a neglected field. Moving on to the review and preview. What happened last week, what's scheduled for this week. Hope for the home buyer. It's been a tough few years for home buyers, but there's a glimmer of hope for 2026. Two new forecasts say home prices will rise modestly next year. Redfin expects a 1% price increase nationally, while Realtor.com sees a 2.2% gain. Both anticipate prices growing slower than wages and mortgage rates averaging 6.3%. Redfin predicts a 3% lift in sales, while Realtor.com estimates 1.7%. But location, of course, is everything. Prices in September continued to rise in northeastern and midwestern metros, tracked by S&P Cotality Case-Shiller home price indices, and slid in Sunbelt metros like Phoenix, Dallas, and Miami. It's what S&P Dow Jones Indices' Nicholas Godek calls a tale of two markets. Realtor.com forecasts that 2026 prices will fall below year-ago levels in 22 of 100 metro areas. Two Florida locales, Cape Coral and Northport, lead in anticipated declines with 10.2% and 8.9% price drops, respectively. In October, active listings in both metros were 13.3% higher than 2024, which probably fuels expectation of softer prices. Elsewhere, prices will climb. Metros with the largest anticipated gains include some of the most affordable housing markets: Toledo, Ohio, 13.1%, Syracuse, New York, 12.4%, and Scranton, Pennsylvania, 10.9%. October listing prices in all three areas were below $300,000, according to Realtor.com, well under the national $424,200 median. And that was written by Shaina Mishkin. What happened last week in markets? Bitcoin continued to swoon, falling 6% on Monday, leading global stocks and bonds down. U.S. stocks fell, with the Dow Industrials down nearly a point, and then rallied amid volatility on hopes for a Federal Reserve rate cut. ADP said the economy lost 32,000 jobs in November, and late November jobless claims fell to a three-year low. On the week, the Dow rose 0.5%, the S&P 500 0.3%, and the Nasdaq Composite 0.9%. In companies last week, Walt Disney's Zootopia 2 took in $156 million in the U.S. and Canada, $400 million internationally. Regulators ordered fixes to a software glitch on some 6,000 Airbus A320s, and the company cut its 2025 delivery target. With its shares down 60% in the Bitcoin sell-off, Strategy established a $1.44 billion U.S. global dollar reserve to pay preferred stock dividends and interest payments. Blackstone, Apollo Global, and KKR will participate in a Bank of England private market stress test. Apple replaced its AI chief, John Ginandrea, with Microsoft's Amar Subramanya. The European Union opened an antitrust probe into Meta Platforms embedding AI tools in WhatsApp. Move to scrap Biden-era car fuel efficiency standards. In deals last week, Netflix said it would acquire Warner Bros. Discovery's movie and TV studio and HBO Max streaming businesses for $83 billion, including debt, beating out Paramount, Skydance, and Comcast. And chipmaker Marvell Technology agreed to buy Celestial AI for $3.25 billion. What's happening this week? On Tuesday, December 9th, the Bureau of Labor Statistics releases the Job Openings and Labor Turnover Survey for both September and October. At the end of August, there were 7.22 million job openings and 1.02 unemployed people for every open position. That's the highest ratio since April of 2021. On Wednesday, December 10th, Adobe and Oracle report quarterly results on Wednesday, followed by Broadcom and Costco Wholesale on Thursday. The Federal Open Market Committee announces its monetary policy decision. The FOMC is widely expected to cut the federal funds rate by 0.25 percentage point to 3.5% to 3.75%. The central bank also releases its quarterly summary of economic projections. In the September SEP, the median projection for the federal funds rate by year-end 2026 was 3.4%, which would imply only one more quarter-point cut, assuming that the FOMC cuts as expected at this meeting. Traders are pricing in a roughly 3% federal funds rate by December of 2026, a much more aggressive easing cycle than currently forecast by the central bank. This may be due to the dovish Kevin Hassett, currently director of the National Economic Council and the favorite to replace Jerome Powell, whose term as Fed chair ends in May. By the numbers, 4.1%. The increase in Black Friday retail sales from 2024, excluding autos, and that's up from 2024's 3.4%, MasterCard estimated. 64%, the percentage of venture funding, roughly $161 billion going into AI over the first 9 months of 2025. 4 million, the International Energy Agency's estimate of excess per day supply of barrels of oil in 2026, a record, and $16 trillion, the combined wealth of the world's billionaires, up 13% since last year from a UBS report. Moving into the articles, the headline, Can AI Make the U.S. More Efficient? Not Fast Enough, by Sergio Flores, by Megan Leonhardt and Adam Levine. Gains in productivity, keys to U.S. economic growth may soon start to ebb. Hopes that AI will come to the rescue look misplaced. U.S. labor productivity growth has been on the rise in recent years, gaining an average of 2.2% a quarter since 2023 due to public and private investments, new business formation, and surging immigration. These forces are now waning, however, adding to the challenges facing the U.S. economy. Many economists and investors expect artificial intelligence to come to the rescue, ushering in a productivity boom in the next few years that will lift gross domestic product and bolster U.S. competitiveness. But it may not come soon enough. Although companies are spending hundreds of billions of dollars in a race to fully capture the benefits of AI, the history of technological advancements argues for caution in estimating how quickly and effectively this investment will pay off. If the anticipated AI-driven productivity gains fail to materialize in the next couple of years, the U.S. could face more inflation, labor challenges, and reduced economic activity. Why productivity matters. Labor productivity is the measure of how efficiently workers generate goods and services. As productivity rises, business typically need fewer employees to produce the same amount of goods or services. Thus, productivity gains can drive economic growth and help to alleviate inflationary pressures. They can also lift living standards. If the U.S. achieves an annual productivity growth rate of 2%, living standards can double every 35 years, according to John Riding, chief economic advisor at Breen Capital. But if growth accelerates to about 3%, as happened from 1995 to 2005, that allows for a doubling every 23 years. Conversely, if productivity growth slows to just 1%, living standards would double every 69 years. U.S. productivity has grown by an average of 2% annually since 1960, although growth slowed to just 1.2% a year in the 2010s. Since 2023, however, labor productivity gains have been pacing at nearly twice that rate on a quarterly basis, and they grew at a 3.3% rate in this year's second quarter. The recent gains in productivity have been driven by investment, changing labor market patterns, and business dynamism, rather than the direct effects of AI. Industries such as hospitality and mining have been among the biggest gainers. Productivity at restaurants, for example, surged more than 15% during the COVID pandemic. Restaurants saw a wave of new business from delivery, but had trouble hiring, so output went up quickly without the complementary rise in labor. The bulk of the post-pandemic productivity outperformance has been driven by higher services productivity, says Goldman Sachs research economist Manuel Abacasis. Yet the U.S. has now wrung out the majority of the productivity gains achieved through COVID-era business upgrades and workforce dynamics, while the most recent drivers of productivity growth, including full employment, fixed investment, and supply-side stability, are ebbing. As a result, the U.S. economy is approaching a potential inflection point. The factors that returned the economy to a roughly 2% annual productivity growth trend may not persist for much longer. With labor force growth slowing due to demographics, the U.S. economy is increasingly reliant on productivity gains to drive growth and improve living standards, says Adam Schickling, senior economist at Vanguard. AI adoption has had a minimal impact on labor and productivity, chiefly because it's still in the early stages. Only about 10% of businesses used any form of AI, including machine learning, natural language processing, virtual agents, and voice recognition to produce goods or services in September, according to the Census Bureau's Business Trends and Outlook survey. Still, that's up from 3.7% in September of 2023. Other surveys, including one conducted by the Federal Reserve Bank of New York in September and another by ADP in October, put regular usage of AI by businesses and workers at much higher levels. But the technology isn't in regular use by the majority of American companies and may take years to generate substantial economic dividends. Economists have written extensively about productivity gains from technological innovation. Indeed, Joel Mocher, Philip Aghion, and Peter Howitt won this year's Nobel Prize in Economic Sciences for establishing the theoretical underpinnings of this dynamic. Stanford University economist Eric Brynjolfsson has also been a leading thinker on the subject. As personal computer use mushroomed in the 1980s and 90s, a mystery unfolded. Where was the productivity growth that so many anticipated? From 1977, when the Apple II computer was released, to 1989, when Brynjolfsson began writing about the productivity paradox, U.S. productivity grew by a meager 1.3% annually, even as PC prices plummeted and sales rose. You can see the computer age everywhere, but in the productivity statistics, said Robert Solow, a Nobel laureate in economics in 1987. But that changed in the mid-1990s, and U.S. productivity grew by 3% a year over the following decade. To address the lag between deployment and productivity gains, Brynjolfsson developed what he called the productivity J-curve, which charts the path of productivity growth following the introduction of a new technology. Technological innovations like AI can reduce productivity growth at first, before the benefits accrue years or even decades later. Electric motors were first used in factories in the late 1880s, but the productivity benefits didn't accrue until 30 years later. Technology by itself rarely delivers productivity just when you plug it in, Brynjolfsson told Barrons. What almost always has to happen is that you have to rethink your business processes. You need to reskill your workforce. You may need to develop new products and services. All this reinvention and co-invention adds a ton of value, but it also takes time. The economic implications. The U.S. is still a few years away from substantial commercial adoption of AI, and perhaps even further away from the promised benefits. Meanwhile, the CBO, Congressional Budget Office, projects that annual productivity gains will need to average at least 1.4% over the next decade for the U.S. economy to grow by 2% a year. But productivity growth may not achieve that pace, given labor trends and the delayed boost from AI adoption. Goldman Sachs research estimates that labor force growth will contribute just 0.3 of a percentage point to potential GDP growth over the next few years, given an aging U.S. population and immigration curbs on worker supply. That's down from 0.8 of a percentage point since 2019. Consumer spending, which accounts for a majority of GDP growth, is also expected to slow from recent highs. Personal consumption expenditures rose by 2.9% in 2024, but the National Association of Business Economics' November consensus forecast was for just 2.5% growth in 2025 and 1.8% in 2026. That leaves productivity growth to do the heavy lifting. Yet, the CBO projects that annual productivity gains will average just 1.3% through the end of the decade. And as a result, most economists expect U.S. GDP growth to fall in coming years below the 2% rate considered healthy for advanced economies. Economists surveyed by FactSet expect the economy to grow by 1.8% in 2026 and 1.9% in 2027. Slowing productivity growth, together with growing government obligations, could force policymakers to make difficult decisions around taxation, public spending, and entitlement outlays, says Vanguard's Schickling. If we're not getting labor growth and productivity gains, the risk of a recession rises, says Gerald Cohen, chief economist at the Frank H. Keenan Institute of Private Enterprise and a professor at UNC at Chapel Hill. There's little doubt that the U.S. is in the early stages of the AI boom, but it's unlikely that this emerging technology will be able to reverse sagging productivity trends soon. The next headline, A Lumber King Selling at a Bargain Price, by Andrew Barry. Weyerhaeuser's shares are beaten up, but they look appealing for investors with a long-time horizon. When it comes to lumber producer Weyerhaeuser, investors can't see the forest for the trees, literally. The 125-year-old company is the largest private owner of timberland in North America, with over 10 million acres, including tracts in the Pacific Northwest where it holds over 2 million acres. It also operates 33 wood product plants across the continent. Weyerhaeuser stock, however, has dropped more than 20% in 2025 due to a weakness in new home construction, as well as in renovation and remodeling activity. This has caused lumber prices to fall 20% this year to $550 per 1,000 board feet. The shares, at a recent $21.69, have lost half of their value since peaking in 2022 and trade where they did in the late 1990s. Fallow periods often lead to renewal, and that's the case for Weyerhaeuser stock, especially for patient income investors. Shares of the Seattle-based company, which yield nearly 4%, now trade for less than the value of the timber assets that Weyerhaeuser accumulated over a century, a fact that offers considerable downside protection to an already battered stock. While Wall Street is downbeat on the housing market in 2026, that view could be too pessimistic. The stock offers massive upside if lumber and wood products markets improve. In our decade plus covering the sector, we can't recall a period where sentiment was as pervasively negative on timber, outside the pandemic market panic in April of 2020, writes Raymond James analyst Buck Horn. He remains constructive, quote-unquote, on the sector due to historic valuation discounts. It may not look that way at first. Weyerhaeuser, structured as a real estate investment trust, or REIT, now operates at just above break-even based on generally accepted accounting principles, or GAAP, earnings. The company is expected to earn 17 cents a share in 2025 and 26 cents in 2026, putting its price-to-earnings ratio near 100. But high valuations in economically cyclical stocks often signal a buying opportunity because they're based on depressed earnings, which should recover. Weyerhaeuser generated over $3 a share in earnings in 2021 and 2022 when lumber prices topped $1,000 per 1,000 board feet. The stock looks far cheaper based on its net asset value. Weyerhaeuser is valued at about $2,000 per acre of its timberland based on its enterprise value of $21 billion, which combines a $16 billion equity market cap with $5 billion of net debt. That valuation is below the $2,800 an acre price of the average timberland transaction in 2024 and 2025. The company's forests in Oregon and Washington state are particularly valuable because they produce desirable wood from Douglas fir trees. Horn puts the company's NAV at nearly $35 a share, while RBC Capital Markets analyst Matthew McKellar estimates it at close to $39 a share, well above the current price. That timber value calculation gives Weyerhaeuser no credit for its wood products plants and output. The company's the number 2 producer of lumber in North America, the fourth largest maker of oriented strand boards and number one in engineered wood products. Its growing Natural Climate Solutions unit leases land for solar and wind farms, generates carbon credits, and participates in carbon capture. Weyerhaeuser's made the most of a rough environment. It cut costs and streamlined operations to maintain profitability. CEO Devin Stockfish said on a third-quarter conference call that the company's worked to align our strategy with the cyclicality of the business. As a result, Weyerhaeuser is a much stronger company today than at any point in recent history. The company probably will drive that point home when it holds an Investor Day on December 11th. That'll be its first since 2021. Management plans to offer financial targets out to 2030. A bullish McKellar, who has a price target of $30, wrote this past week that he sees a somewhat positive risk-reward skew into the event. With sentiment so poor, he's probably right. Weyerhaeuser takes a long-term view, and investors should too. The company views itself as a business, but also a steward of its vast land holdings with a limitless time horizon. This is not for us, nor for our children, but for our grandchildren, said the company's founder, Frederick Weyerhaeuser, in the early 20th century. And that remains true today. Timber isn't a wasting asset, with trees growing about 2.5% a year. Weyerhaeuser plants 100 million new trees a year and cuts just 2% of its vast forests annually. It amounts to a giant carbon sink, probably the largest in the country. One of timber's great selling points, its renewable nature, also means wood is less likely to be in persistently tight supply. It's possible that Weyerhaeuser could attract an activist who pushes it to be more aggressive on land sales and then use those proceeds to buy back stock. No matter how value is unlocked, investors are getting paid to wait. Weyerhaeuser now pays an 84-cent annualized base dividend, resulting in a nearly 4% yield. Weyerhaeuser says the base dividend is sustainable even at the bottom of the cycle. This year, Weyerhaeuser is expected to generate about 80 cents a share in funds available for distribution, or FAD, a REIT cash flow measure. The company aims to pay 75 to 80% of its FAD to shareholders each year in dividends, both regular and special, and stock repurchases, while boosting its base payout by 5% annually. It's bought back $150 million of stock so far this year, about 1% of the market cap. Time is on Weyerhaeuser's side. America needs more housing, and home building will eventually recover, and so will the stock. This tree doesn't have to grow to the sky for it to work for investors. The next headline: It's time for your year-end portfolio review by Elizabeth O'Brien. A good year for stocks and big gains in tech may be making your portfolio too risky. How to get it in shape for 2026. It's always smart to take stock of your portfolio in December, but this year it's especially key. The investment landscape may be shifting, and retirees can't afford to coast into 2026 on autopilot. The S&P 500 index and the NASDAQ composite are posting their third consecutive year of double-digit returns. Artificial intelligence has been the market's lifeblood, but it's debatable how much longer the AI trade will last. Also unknown is the impact of AI on corporate profits and the economy, and how that will affect markets. We've yet to see how the AI-driven productivity boom plays out, said Kevin Kong, senior international economist at Vanguard. If the tech bulls are right, AI could become as transformative as electricity, he says. That would keep propelling equities and economic growth. It's also possible that AI's impact will be more subdued, while the U.S. grapples with rising debt and deficits. For the next few years, it'll be a horse race between AI and deficits, Kong says. Many investment pros expect the stock market to keep rising in 2026. CFRA research sees the S&P 500 at 7,400 by the end of 2026. That would be an 8% gain from recent levels around 6,860. Historically, midterm election years are extra volatile for markets, according to CFRA Chief Investment Strategist Sam Stovall. But he sees a more muted market chugging ahead on the back of the Federal Reserve's interest rate easing cycle and double-digit earnings growth expectations for 2026 and 2027. Another good year is no guarantee, though, and investors may have forgotten how to play defense after a long stretch of gains. If the economy tips into a recession, the market will almost certainly fall. If your portfolio isn't ready, you could face steep losses. Here are some ways to prepare and year-end moves to consider. Consolidate your accounts. It's hard to take a holistic view of your portfolio when your investments are scattered. Nearly a third of near retirees reported having 2 or more 401ks, according to Allspring's 2025 retirement study. If you suspect you've lost sight of an old account, you can search the government's Retirement Savings Lost and Found database. Investors may think they're diversifying by spreading their money around at different firms. What matters is your asset mix, regardless of where it's held. Having multiple accounts at different firms may also be more trouble than it's worth, says Bethany Deaver, a certified financial planner at Rockland Trust. Investors can lose sight of proper rebalancing, performance tracking, and tax reporting, she says, and they may miss out on volume discounts for bigger balances. More investors are getting the message. From 2024 to 2025, the share of households with investable assets of $1 million to $4.9 million at only one financial institution jumped 11 percentage points to 22%, according to research firm Hearts and Wallets. Even if you're comfortable juggling accounts across multiple firms, chances are your loved ones won't be. Once the primary money manager in a couple becomes infirm or dies, it's a burden on the spouse to have all of these accounts, Deaver says. What's more, many financial institutions have their own power of attorney protocols. The fewer of them your loved ones have to deal with, the better. Keeping your accounts at one brokerage should provide enough protection against fraud or a firm going bankrupt. Major brokerages carry excess coverage well above the Securities Investor Protection Corp, or SIPC, insurance of $500,000 per account type per member firm. This coverage doesn't protect against market losses, just brokerage failure and certain kinds of fraud. By contrast, the FDIC, Federal Deposit Insurance Corp, insurance protects cash up to $250,000 per depositor per bank. Savers with higher cash balances have an incentive to spread their money across different institutions. Diversify, truly. With your investments in one place, it's easier to tell if your asset mix is aligned with your goals. Your portfolio will drift according to the underlying performance of stocks and bonds, so your balance can get out of whack over time. Investors who began retirement 10 years ago with a portfolio of 60% stocks and 40% bonds and haven't touched it since would now have more than 80% in stocks, according to an illustration by Morningstar. Holding 80% in equities would be too risky for most retirees, especially given stocks' lofty valuations. The S&P 500 trades at a forward 12-month price-to-earnings ratio of 22.4, above the 5-year average of 20 and the 10-year average of 18.7, according to FactSet. The market's weighting in giant tech stocks like Nvidia, Microsoft, and Alphabet is another concern. The top 10 stocks in the S&P 500, which is weighted by market cap, constitute nearly 40% of the index. Most are AI-related names. Few pros would recommend exiting big tech stocks altogether. But if you have an outsized allocation, now's the time to trim. Within equities, Vanguard's Kong recommends that retirees keep less than 50% in the S&P 500. For the remainder, he suggests diversifying within the U.S. and international equity universes. That may include small and mid-cap stocks, value stocks, and non-U.S. markets. One simple way to diversify your U.S. stock holdings is with the Invesco S&P 500 Equal Weight Exchange Traded Fund, which holds every stock in the index in equal amounts. It doesn't have the tailwind of mega-cap tech, but it's faring well this year, up 10% versus 15% for the S&P 500. Value stocks are another good diversifier, since the S&P 500 is tilted toward growth. The Dow Jones Industrial Average has a value tilt, Kong says, and many of its components pay a dividend. The SPDR Dow Jones Industrial Average ETF is one way to play it. While the fund still has tech names like NVIDIA, it also owns value-oriented stocks like Verizon Communications, and it pays a 1.5% dividend. Some fund managers are looking to diversify beyond AI. One way to do it? Look for companies that will benefit from AI spending regardless of whether the Magnificent Seven companies recoup their own massive investments. Think electricity and other infrastructure providers that are needed to build AI data centers, said Neil Hennessy, chief market strategist at Hennessy Funds. If you think pork will go up, you don't buy the pig, you buy the feed manufacturer, Hennessy said at an investment outlook event in November. One stock Hennessy owns for his firm's investors is Granite Construction. The company builds roads and sells construction materials such as asphalt, and it's benefiting indirectly from AI as companies need access roads to data centers. There's strong demand associated with data center infrastructure improvements and expansion and development, said CEO Kyle Larkin on a recent earnings call. Granite has a market cap of $4.7 billion and earnings growth projected at 30% in 2026 to $5.54 a share, according to consensus forecasts. Shares trade at 19 times earnings, a slight discount to the market. Small and mid-cap stocks have other benefits, said Paul Stanley, Chief Investment Officer of Granite Bay Wealth Management in Portsmouth, New Hampshire. Mid-caps have lagged behind the S&P 500 for years but offer more attractive valuations, he says. They also tend to be domestically oriented industrial and financial companies that don't have as much exposure to tariffs and dollar risk. Small caps should benefit from lower interest rates since they tend to borrow more. ETFs offering exposure include Dimensional U.S. Small Cap and iShares Russell Mid Cap Growth. And don't neglect international stocks. After years of lagging behind U.S. stocks, international stocks are up 30% this year. U.S. stocks make up about 65% of the world's equity market cap, so some pros recommend that investors hold about 35% of their stock allocation outside this country. An ETF like iShares MSCI ACWI ex-US is an easy way to get access. And bonds are back. Once your equity exposure is diversified, consider your overall mix of stocks and bonds. If your stock portion has ballooned beyond its target, sell some winners and buy bonds to get your allocation back on track. The outlook for fixed income is solid, Kong says. It isn't like 2020 when paltry bond yields meant there was no alternative to stocks, a phenomenon known by the acronym TINA. Nor is it like 2022, when rapidly rising interest rates caused bond prices to plunge, since the two move inversely. Instead, bonds have returned to normal valuations. Anders Persson, Chief Investment Officer and Head of Global Fixed Income at Nuveen, expects 10-year treasuries to stay in the 4% vicinity through the end of 2026. That's a respectable coupon for retirees to clip. If the Federal Reserve continues to cut rates, there's more possibility for total return, including price gains. The iShares Core U.S. Aggregate Bond ETF is a simple way to get exposure to the intermediate part of the yield curve that many pros find attractive right now. Alternatively, actively managing funds look for opportunities throughout the whole fixed income landscape. Examples include Nuveen Strategic Income and Dodge & Cox Global Bond, the latter including international debt securities. Municipal bonds remain attractive for investors in higher tax brackets since the income they generate is generally exempt from federal and state taxes for residents of the state that issued the bond. The low-cost Vanguard tax-exempt bond ETF is a solid choice. It yields 3.5%, or a taxable equivalent north of 5% for investors in the top 3 tax brackets. And manage your taxes wisely. If you're tweaking your portfolio, it's usually most tax efficient to make changes within a tax-deferred retirement account like a traditional 401k or an IRA, since buying and selling within these accounts won't generate taxable capital gains. Of course, if your goal is to realize losses to offset gains in a taxable account, confining your activity to tax-deferred accounts would be a minus. Investors age 73 and over who are subject to required minimum distributions can use their RMDs as a rebalancing tool. Consider taking your RMD from an overweighted part of your portfolio. If you don't need the money to live on, invest the proceeds in a taxable account in an asset class where you are underweight. If your cash cushion isn't big enough, there's another good place to plow your proceeds. Nearly a third of RMDs at Fidelity are taken in November and December, according to a spokeswoman. This year offers slim pickings for tax loss harvesting. That's the practice of selling losing positions to offset taxes on capital gains, which may be plentiful this year. One way for retirees to avoid capital gains and get a tax break is by transferring appreciated stock to charity. A donor-advised fund offers maximum flexibility. You can transfer appreciated shares to the fund and get an immediate tax deduction, then take your time deciding how and when to disperse the proceeds to charities. Through 2025, taxpayers can typically get a tax deduction from charitable giving only if they itemize their deductions. But starting next year, taxpayers who take the standard deduction will receive an above-the-line charitable deduction of up to $1,000 for a single person, $2,000 for a married couple filing jointly. And that gives taxpayers who take the standard deduction a reason to push their charitable giving into January of next year. While you can time your charitable giving, you can't time the market. That's why it's helpful to review your portfolio and rebalance it on a fixed schedule rather than in response to market gyrations. Because some of your moves may have tax implications, December's a good time to get it done. And with that, we've come to the end of our reading of Barrons magazine dated December 8th of 2025. This is your reader Eric saying be well, be safe, look after each other. And remember our veterans, especially those we've lost recently. Bye for now.